Have you been planning to buy a home this year, but the rapid rise in interest rates has cut your budget by $50,000 or $100,000, or increased the monthly payment for the type of house you wanted by $500 or $1,000 or more per month? You wish you could go back in time and get a lower interest rate? Well, stay tuned because today I'm going to show you 3 ways to beat the current market interest rates right now so you can buy the house of your dreams. That's coming up next. Hi, I'm Ryan Nicholas with the Damon Sells Homes team at Coldwell Banker, and my team and I help home buyers navigate the complex Northern Virginia home buying market using our smart home buying strategy, a proven, repeatable system backed by market research and decades of experience, using little-known strategies and tactics to help you find the perfect house, buy it for the least amount of money, and avoid the common mistakes you might make that can cost you tens of thousands of dollars. Be sure to comment below if you have any questions about something you hear in the video today. I'll read and respond to every comment. And of course, please subscribe to my channel if you want to watch more videos to help give you an edge in the Northern Virginia real estate market. If you're like most home buyers, you may be a little discouraged and frustrated in the home buying process due to the higher mortgage interest rates right now. Inflation has driven up the price of so many things, especially mortgage rates, which have nearly doubled this year. Today, I want to teach you 3 different ways to get an edge over your competition and save money on your mortgage. Number 1 is buy down your interest rate. Ask the seller to give you a credit towards buying down your rate instead of lowering the purchase price. This works because the number 1 fear of mortgage companies in a high interest rate environment is that you will refinance if rates drop. They want to incentivize you to buy the rate down now so that you keep your mortgage with them for the long run. So for example, let's say you're buying $1 million home at 20% down. And let's say you're able to negotiate $8,000 off the price. That's a $992,000 purchase price. At 20% down, that's a $793,600 loan amount. At 5.5% interest, that's a $4,506 a month mortgage payment. Or you could buy your rate down with that $8,000. So it would be $1 million purchase price at 20% down with an $8,000 credit from the seller to buy the rate down. That's an $800,000 loan amount at a 5% interest rate, let's say. That equals a $4,295 a month mortgage payment. That's a savings of $211 per month or over $2,500 per year. Buying down your interest rate is a no-brainer if you're planning on staying in the home for over 3 years. And the seller doesn't really care either way because they net the same amount either way. Number 2 is ARMs. ARMs are making a big comeback. They've been almost non-existent over the last several years. One lender I talked to recently said they've gone from almost none of their loans being ARMs to almost a third of their loans being ARMs. So what is an ARM? It's an adjustable rate mortgage. You lock in a lower interest rate for a specific amount of time, usually 3, 5, 7, or 10 years, after which the rate can adjust. Now, recently, folks have been worried about the rate adjusting up because rates have been so low. But remember, the adjustable rate is tied to what is going on in the market. So it is possible that your rate could even adjust down, which is more likely in a market we have today with higher rates. So even if your rate does adjust up, just remember that you're saving a lot of money in interest over the initial term of the loan. For example, a break-even point on a 7-year ARM is often around the 10 or 11-year mark in the worst-case scenario. The average American keeps their loan for a far shorter amount of time than that, but it's still, of course, wise to plan for the worst-case scenario and ensure you can afford the payment if the rate does adjust up. An ARM can be ideal if you're thinking shorter term for your home purchase. For example, if you're a newlywed planning to move to a bigger home once you start a family, or if you're in the military on a 3-year posting, etc. Number 3 is utilizing some of your local credit unions and local lenders. There may be some credit unions or lenders in your area that are offering more competitive rates than what you see in the news. Your realtor should be able to provide you a recommendation for somebody. So if you're planning to stay in your house for a long time, look into buying down your interest rate, If you're only planning on staying in your house for a short time, definitely look into an ARM. And either way, I highly recommend you work with a local lender or credit union. Thank you so much for watching this video. If you'd like to schedule a time to talk about buying a home in Northern Virginia, I've made it really easy for you. Just follow the instructions in the description below. And if you got value from this video, please like it, and I'd love it if you could share it with somebody else you know who might get value from it too. Also, be sure to subscribe to my channel and check out the other playlists for more great information on the Northern Virginia real estate market.